We are diving deep today into the story of a company that, in many ways, really charted the course for mainstream cryptocurrency adoption right here in the United States.
Mm-hmm.
But make no mistake, this journey was never a smooth cruise to the top.
Not at all.
It was more of a turbulent, often chaotic whitewater rafting trip featuring, unprecedented financial booms, sudden regulatory landmines, intense internal culture wars.
And even, the high-stakes drama of international cybercrime. It's really a perfect case study.
It really is.
If you want to understand the entire arc of the crypto industry's attempt to professionalize and mature, you just have to look at Coinbase Global Inc.
And we get the sources to do it.
We do. We're holding a stack of sources detailing its history, its products, its highly volatile financials, and I think perhaps most importantly, its legal compliance battles.
So our mission today is pretty straightforward.
Yeah.
We want to unpack the complete history of Coinbase, from its small 2012 founding out of a startup incubator,
Right?
all the way up to its major strategic movements and legal showdowns through late 2025.
It's really the story of an entity constantly fighting for legitimacy, either, catching up to or actively fighting with regulators.
All while becoming the custodian for over $500 billion in digital assets. It's just a staggering amount of responsibility.
And what's fascinating here is just the sheer audacity required to navigate that shift.
How so?
Well, they began as this scrappy startup sort of advocating for decentralized finance, yet they became a public S&P 500 entity by defining what it means to be a hyper-compliant, law-abiding crypto exchange.
In an industry that's historically been really skeptical of any centralized authority.
Exactly. That tension is the core of their business model.
That tension is what we need to explore. Okay, let's unpack this journey, starting right at the very beginning. So the founding story is, it's a classic blend of Silicon Valley innovation and Wall Street pragmatism.
It really is. It began in June 2012 with Brian Armstrong, who was a former engineer from Airbnb. He brought the technical vision.
And he found his co-founder, Fred Ursum, who was a former Goldman Sachs trader of all places, on Reddit.
On Reddit, yeah. It's that perfect, necessary combination of deep technical understanding on one side and traditional financial market experience on the other.
And they needed to signal their intent right away.
And they did. Securing that early momentum was crucial. Almost immediately, they received a cash infusion of $150,000 by enrolling in the prestigious Y Combinator Startup Incubator Program.
And that wasn't just seed money, was it?
No, not at all. It was an instant stamp of traditional tech legitimacy. It suggested they were aiming to build a scalable, venture-backed enterprise, not just some niche peer-to-peer service.
And here's a piece of, I think, surprising founding trivia that is hugely symbolic of the philosophical splits you see in crypto.
Mm-hmm.
There was actually a third founding member, Ben Reeves, the co-founder of blockchain.info.
Right. But he parted ways right before that Y Combinator funding, and the reason was very specific. It was a fundamental disagreement over how the Coinbase wallet should operate.
And that one disagreement tells you everything you need to know about the future of centralized exchanges.
It really does. Reeves wanted what's called a non-custodial wallet, where users would maintain control over their own private keys. The crypto ethos of be your own bank.
But Armstrong and Ursum pushed for a custodial solution.
Yes, where Coinbase manages the keys for the user's convenience. By opting for custody, they implicitly chose convenience and ease of use over that core crypto ideal.
And that set the stage for their entire regulatory path.
Absolutely.
And the name itself, Coinbase. It's highly technical, almost like rooted in the mechanics of the Bitcoin protocol.
Precisely. It's named after Coinbase transactions, which are these special, unique transactions that happen when new cryptocurrency is introduced into circulation on a proof-of-work blockchain, like Bitcoin.
It's the transaction that pays the miner who successfully validates a block.
Exactly. Choosing such a technical foundational name suggested they saw themselves as integral to the infrastructure of crypto, not just another marketplace.
And they launched their services just 4 months later.
Yep. October 2012, they were allowing users to buy and sell Bitcoins for the first time using simple bank transfers. They were building the first really friendly on-ramp.
And their early scale-up showed a massive appetite from traditional investors.
Oh, huge. By May 2013, they had secured a $5 million Series A. Just 6 months after that, they snagged a huge $25 million investment led by Andreessen Horowitz.
That kind of rapid accumulation of VC money was just unheard of in the early crypto space.
It was. And it cemented their perception as the most legitimate player. That trend really climaxed in January 2015 when they secured a $75 million funding round.
And this round included some traditional finance heavyweights.
It did. People like the New York Stock Exchange and USAA were throwing their support behind the company. This was crucial for moving them beyond the realm of just internet money and into the perception of a regulated financial services provider.
And that legitimacy helped them build out their user base and their partnerships pretty aggressively.
By 2014, they already boasted 1 million users. They were also busy acquiring smaller companies, integrating services like the Blockchain Explorer service Blocker and the social bookmarking service Kipt to consolidate talent and tech.
Their partnership strategy was just as aggressive.
They weren't just facilitating retail trades, they were pushing Bitcoin into traditional commerce infrastructure.
You have to think back to 2014 when major retailers like Overstock, Dell, Expedia, Dish Network, and even Time Inc. suddenly announced they would accept Bitcoin.
And Coinbase was often the engine running those transactions, integrating Bitcoin into the traditional checkout process.
They were integrating it into the payment ecosystem, too.
Right. That same year, they added Bitcoin payment processing to key financial infrastructure players like Stripe, Braintree, and PayPal.
This infrastructure push led them directly to focusing on professionalization.
It did. In January 2015, they launched their dedicated U.S.-based Bitcoin exchange for high-volume professional traders. This platform was later rebranded as the Global Digital Asset Exchange, or GDAX, in 2016.
And that was a clear move to separate the casual retail investor from the institutional market.
Exactly. It allowed them to offer more sophisticated tools and lower fees for the really serious players.
And that professional platform, GDAX, it underwent another major transformation later in the decade.
It did, rebranding again to Coinbase Pro in May of 2018. And at the same time, they launched Coinbase Prime, which was dedicated entirely to institutional clients, the hedge funds and massive asset managers.
This market segmentation was key, but it only really worked because they embraced the regulatory structure.
That's the key. In early 2017, they achieved a major legitimacy milestone by obtaining the highly complex and, frankly, sought-after BitLicense.
Along with trading licenses for Ethereum and Litecoin from the New York State Department of Financial Services, the NYSDFS.
And these licenses were non-negotiable for anyone operating legally in New York. It really distinguished Coinbase from competitors who were operating in a much more ambiguous regulatory environment.
But operating as a regulated entity meant inviting some pretty serious scrutiny, particularly from the IRS.
The IRS came knocking in November 2017. They ordered Coinbase to report user data for anyone who had at least $20,000 in transactions in a single year.
So what did that mean for users?
Well, Coinbase later notified about 13,000 affected customers in February 2018 that their taxpayer ID, name, address, and transactional records from 2013 to 2015 would be handed over.
And that demand marked a definitive turning point.
It really did. It's where the early myth of cryptocurrency anonymity began to dissolve for mainstream exchange users. The government made it crystal clear. If you use a centralized U.S.-based exchange, you are traceable, and your transactions are taxable.
Stepping back for a moment, they weren't just focused on trading, they were also investing in the future of the ecosystem itself.
That's right. In April 2018, they launched Coinbase Ventures, an early-stage venture fund, and their very first investment went to Compound Labs.
So they were trying to create a sort of self-reinforcing loop.
Exactly. And we can't overlook their foundational role in the stablecoin market, which is now critical to global crypto trading stability.
Right. It is USDC.
In September 2018, Coinbase was part of the Center Consortium alongside Circle and Bitmain that launched USD Coin, or USDC. It quickly became fundamental because it provided a dollar-pegged asset that enabled stable, liquid trading.
And Coinbase still maintains a significant equity stake in the issuer, Circle.
They do.
So finally, their commitment to compliance and technical sophistication led them to a major acquisition in 2019 that immediately plunged them into a huge controversy. Neutrino. In February 2019, they acquired this blockchain intelligence platform, but they faced immediate internal and external backlash. So why did this deal go so sideways so fast?
Well, because the founders of Neutrino had direct connections to the infamous hacking team.
And hacking team had a terrible reputation.
A terrible reputation for supplying aggressive internet surveillance technology to governments with, frankly, abysmal human rights records globally. This created an instant ethical and reputational red flag for Coinbase, which was trying to project this image of pristine legitimacy.
So it put CEO Brian Armstrong on the defensive.
It did. He responded directly, admitting that the company did not properly evaluate the deal from a due diligence perspective.
And crucially, the sources note that staff formerly associated with Hacking Team were transitioned out of Coinbase following the backlash.
Yes, and it shows the fine line these centralized crypto exchanges have to walk. They need robust blockchain intelligence tools for regulatory compliance and tracing illicit funds.
But they have to avoid any association with surveillance practices that violate user trust. It's a real tightrope. Moving into 2020, the company was gearing up for its public debut, but it also underwent these massive structural and cultural changes, which were largely accelerated by the pandemic.
That's right. In May 2020, Coinbase announced it was shifting completely to remote work and would no longer recognize a formal headquarters. They committed to operating as a remote-first company until at least 2025.
That was a defining, sort of pioneering structural decision.
It really was. By shedding that traditional headquarters model, they gain a ton of operational flexibility, but also face unique challenges in maintaining corporate culture and internal cohesion.
Especially while preparing for the intense scrutiny of a public listing.
Exactly.
But despite that remote dispersion, they were still aggressively acquiring technology they needed to scale.
Right. They bought Tagomi, a high-end digital asset trading firm, for a significant sum somewhere between $75 and $100 million.
And later, they acquired Agara.
Yes, an AI-powered support platform for $40 to $50 million, specifically to automate and improve their often criticized customer experience tools.
That investment in customer support automation through Agara, it really foreshadowed the massive customer service issues that were still looming, which we will definitely touch on later.
Mm-hmm. But this period was also defined by some deep internal friction surrounding social and political activism, right at the moment the company was trying to define its public identity.
And that friction really came to a head in June of 2020.
It did. Following the murder of George Floyd, the CEO faced severe internal backlash for initially refusing to make a public statement about the Black Lives Matter movement.
Citing the company's commitment to an apolitical culture.
Right. And although he later offered some acknowledgement on Twitter, the internal debate was fierce. Armstrong eventually doubled down on his stance in September 2020.
With that highly consequential blog post that outlined the mission-focused philosophy.
That's the one. He emphasized that Coinbase would not engage in social or political activism, explicitly citing the harm and distraction he believed it had caused other tech firms like Google and Facebook.
And this wasn't just a memo, was it? He made the policy immediately actionable.
He did. He offered a generous severance package for any employees who disagreed with this non-political direction and chose to leave.
What was the implication of forcing that choice on staff?
It reinforced this idea that Coinbase was going to be a pure financial services utility focused solely on its crypto mission. This created a cleaner narrative for Wall Street, a focus on profit and infrastructure, free from distracting social debates.
But it cost them a number of employees who felt the company should be more socially engaged.
It did. And this attempt to enforce an apolitical culture became one of the key narratives surrounding the company heading into the IPO.
Yet the internal scrutiny regarding transparency and compensation didn't just go away.
Definitely not. In December 2020, the New York Times published a pretty damaging report based on 2018 compensation data.
And it suggested that women were paid an average of 8% less and Black employees 7% less than comparable male and non-Black employees in similar roles.
Which was an exceptionally poor look for a company about to debut on the public market.
It's important to provide the counterpoint here, though, because the analysis was incomplete.
Absolutely. The critical context is that the analysis, as it was published, made no adjustments for education or experience levels.
Which doesn't negate the disparity, but it does complicate the simple narrative.
It does. And in response, Coinbase took aggressive corrective action in May 2021. They eliminated salary and equity negotiations during recruiting entirely.
The goal being to ensure that all employees in the same position, in the same location, receive the same salary and equity offer.
Right. They used data to infer strict internal pay parity, which was a significant move for a rapidly scaling tech firm.
So after all this internal turbulence, the stage was finally set for the blockbuster public listing.
And by Q1 2021, the market was absolutely feverish. Coinbase reported a 9-fold increase in first quarter revenue, hitting a massive $1.8 billion.
A jump attributed overwhelmingly to the historic surge in the price of Bitcoin and Ether.
That financial momentum set up one of the most anticipated public listings in years. On April 14th, 2021, Coinbase debuted on the NASDAQ exchange.
And they opted for a direct stock listing, a DPO, rather than a traditional IPO, Remind us why that route was significant.
Well, a direct listing means the company sells existing shares rather than issuing new ones. It allows employees and existing investors to sell their shares immediately without the dilution and lockup periods you see with a traditional IPO.
So it signaled a lot of confidence from the founders and investors.
It did. The Nasdaq set a reference price of $250 a share, valuing the company at $47 billion pre-market.
And the market reaction was explosive.
It really was. Coinbase closed its first day of trading at $328.28 per share, valuing the company well over $60 billion.
Now, that IPO was the single biggest moment where cryptocurrency, represented by this hyper-compliant, regulated entity, truly crashed the gates of Wall Street and traditional finance.
No question.
But the immediate aftermath of the listing was defined by a major regulatory skirmish with the SEC over a planned product called Lend.
Correct. In September 2021, the U.S. Securities and Exchange Commission reportedly threatened to sue Coinbase if they launched their cryptocurrency lending product, Lend.
Because the SEC viewed the interest-bearing product as an unregistered security offering.
Right. But what made the situation so confusing for the company and the broader market was that similar crypto lending products were already being actively offered by competitors.
So Coinbase felt like they were being unfairly targeted.
They did. They publicly expressed intense confusion, even a degree of anger. They claimed the SEC hadn't even provided a satisfactory legal reason for the threat.
So what did they do?
Despite the confusion and the existence of these similar products, they canceled the launch of Lend.
And that decision was a critical move that reinforced their image as a conservative, compliance-first exchange.
It really was. They chose not to engage in an early, high-profile legal fight with the SEC, prioritizing their legal status even when they fundamentally disagreed with the regulatory action.
And just to close out that year, with a moment of market chaos, we had the famous trillionaire glitch.
That was a fun one. In December 2021, Coinbase experienced a major display glitch that vastly inflated user balances, incorrectly showing numerous users as trillionaires or multi-billionaires.
So no funds were actually lost or gained?
No, but can you imagine the moment you logged in and thought you had become the wealthiest person on Earth? It was a momentary lapse that really showed the fragility of the technology under immense scale and pressure.
The whole atmosphere shifted dramatically as we move into 2022. The early success of the IPO was pretty quickly overshadowed by a major market contraction.
It was, and it started with operational hurdles overseas.
Specifically in India, right, one of the world's most promising crypto markets.
Exactly. Coinbase started operations there in April 2022, intending to use the widely adopted Unified Payments Interface, or UPI, to let users easily convert rupees into crypto.
But the National Payments Corporation of India, which oversees UPI, it quickly issued a public statement.
They did, and they said they were not aware of any crypto exchange using UPI, which created immediate severe friction.
That swift rejection from India's National Payment Authority forced Coinbase to suspend rupee conversion services almost immediately.
It did, effectively suspending most of its fiat to crypto business in India. And it highlights this persistent challenge for compliant exchanges. Integrating into a major nation's banking infrastructure often requires explicit, high-level regulatory buy-in.
And Coinbase moved without it.
Right. Then came the famous crypto winter. The global market downturn put Coinbase under severe financial pressure, leading to 2 massive rounds of layoffs.
The initial cut in June 2022 was painful.
It was. 18% of their global workforce, about 1,100 full-time jobs, were eliminated. Then in January 2023, they cut another 950 employees.
And CEO Brian Armstrong explicitly tied these reductions to the macroeconomic downturn and, critically, the possibility of further contagion after the FTX collapse.
Yes. He emphasized they were shutting down several projects where we have a lower probability of success. The cuts were an attempt to safeguard the balance sheet during a period of zero visibility and massive industry failures.
So they were bleeding money, but they used this downturn to secure strategic institutional partnerships that solidified their position as the trusted intermediary.
Exactly. While the retail market suffered, Coinbase pivoted hard to institutional clients. In August 2022, they partnered with BlackRock, the world's largest asset manager.
And this deal allowed BlackRock clients using that massive Aladdin investment management system to oversee their Bitcoin exposure and facilitate trading directly on Coinbase's exchange.
It was a critical vote of confidence during the deepest part of the winter.
They also struck a major deal with Google Cloud Platform.
Yes, in October 2022, Google Cloud agreed to accept crypto payments for cloud services using Coinbase Commerce.
And just as important, Coinbase agreed to transfer its own data apps from Amazon Web Services to Google Cloud as part of the deal.
Right. These partnerships signaled to the market that Coinbase was structurally sound and actively integrating with the biggest traditional financial and tech players.
So now we come to the defining drama of the past few years. The core regulatory battle with the SEC, which really dominated their operating environment.
It began in earnest in March 2023 when they received the dreaded Wells notice from the SEC.
For those unfamiliar, a Wells notice is a formal letter from the regulator signaling their intent to recommend enforcement action. It's basically a pre-lawsuit warning.
It is, and it carries significant legal and stock market implications immediately. The SEC signaled they intended to sue specifically over Coinbase's staking products, which they claimed were unregistered securities.
And Coinbase, predictably, responded defensively, calling the investigation cursory.
But they didn't just wait for the inevitable lawsuit. They went on the offensive.
It was a bold move.
It was. In April 2023, Coinbase preemptively sued the SEC, asking a federal court to compel the regulator to respond to a petition for clear crypto regulations that Coinbase had filed months earlier.
They were essentially forcing the SEC's hand, arguing, you either give us clear rules or you must legally acknowledge why you won't. And the SEC responded in kind just 2 months later, in June 2023, filing their massive lawsuit. What were the key allegations that made this an existential threat?
The core allegations were comprehensive and spanned years. They claimed Coinbase had been acting as an unregistered broker, an unregistered national securities exchange, and an unregistered clearing agency since 2019.
And on top of that, they alleged that Coinbase had never registered its staking service, Coinbase Earn, as required by U.S. securities laws.
Right. And the lawsuit asked for a permanent injunction, meaning the SEC requested the court to permanently restrain and enjoin the company from ever doing this unregistered business again, which would have crippled their operations.
So this litigation was absolutely foundational to the crypto industry's future in the U.S. How did this massive legal showdown end?
Well, it ended abruptly. In February 2025, following the election of Donald Trump, the SEC filed to dismiss its lawsuit against Coinbase, bringing the multi-year legal battle to a sudden conclusion.
So the change in political administration led to a shift in regulatory enforcement.
Clearly, it lifted an enormous legal burden from Coinbase's shoulders.
That is a colossal outcome. So with that threat gone, let's look at the major achievements and incidents that happened in 2025 alone, which really demonstrates the pace of their expansion.
The momentum was immediate. In March 2025, Coinbase officially became the largest single node operator on the entire Ethereum network,
Controlling 11.42% of all staked Ether.
Right. This means they are a foundational pillar of Ethereum's security, its operation, and, you could argue, its governance structure, given the influence that concentration of staking power grants.
But that same year, they also faced a massive corporate security test, a serious cyber extortion attempt in May 2025.
This incident was fascinating and, frankly, terrifying. The company disclosed that cybercriminals had successfully bribed rogue overseas support agents, people working within their outsourced system, to steal customer data for use in sophisticated social engineering attacks.
And Coinbase took a firm stance. They refused to pay the $20 million ransom demanded by the cybercriminals.
A massive corporate security decision. But it came with a predicted high cost for the breach itself.
It did. To mitigate the risk and maintain customer trust, Coinbase immediately offered a $20 million reward for conviction information related to the attackers.
And they reported that less than 1% of customer data was actually impacted, but they publicly disclosed that they expected the total cost, including customer reimbursements and security upgrades, to be up to $400 million.
That just demonstrates the immense financial cost of maintaining security and trust when you scale global support operations.
And while dealing with that breach, they were executing massive strategic mergers and acquisitions.
That May, they acquired Deribit,
a major Dubai-based cryptocurrency derivatives exchange. The deal was enormous. $700 million in cash plus $2.2 billion in Coinbase stock, valuing the acquisition near $3 billion.
which was a clear, aggressive move to expand into the lucrative derivatives market, allowing them to offer futures and options trading.
Exactly, a key revenue stream usually dominated by traditional financial institutions.
And finally, the ultimate symbol of traditional financial legitimacy, inclusion in the S&P 500 index on May 19, 2025.
That event, just months after the SEC lawsuit dismissal, was the culmination of their 13-year journey. It confirmed their status not just as a profitable crypto company, but as a stable, massive institutional entity integral to the broader U.S. financial landscape.
And despite their established remote-first ethos, they were making physical real estate moves too.
Absolutely. Which underscores their commitment to compliance. In June 2025, they opened a large dedicated office in Charlotte, North Carolina, specifically designated as a center of excellence for their compliance and customer support teams.
They also leased new office space in San Francisco, sort of reversing that earlier decision to completely abandon a physical headquarters.
Right, signaling a need for anchor points for corporate and regulatory functions.
And wrapping up 2025, we noted their high-level political influence, being listed as a donor funding the White House's East Wing demolition and a planned ballroom.
That kind of high-level political involvement really shows how integrated they have become into the Washington ecosystem, especially after that major regulatory victory.
Let's shift our focus now to the modern platform. What exactly is Coinbase today? It's far more complex than just a simple place to buy Bitcoin.
Oh, absolutely. They maintain a very clear delineation between their retail products and their specialized institutional services.
So starting with the retail side, the foundation is, of course, the Coinbase app.
The core application that millions use for buying, storing, and trading cryptocurrencies, they began supporting Ether way back in July 2016.
And for those who want more sophisticated charting and trading options, they have Coinbase Advanced.
Right, which evolved from the original Coinbase Pro. This caters to high-volume individual traders, and notably, they even added popular meme coins like Dogecoin support in June 2021 to capture that market segment.
They're also pushing recurring revenue and rewards through premium services.
They are. They offer Coinbase One, a premium feed-based plan with extra features and fee reductions. And their staking service, Coinbase Earn, is extremely popular.
This is where users lock up their crypto or stake it to validate transactions on proof-of-stake blockchains like Ethereum and earn rewards.
And as we noted, this service was the flashpoint for the SEC's legal threats, placing it squarely in the crosshairs of the regulatory debate over what constitutes a security.
And the Coinbase wallet is currently undergoing a massive strategic transformation.
It is. The traditional Coinbase wallet, which allowed customers to access decentralized apps, or dApps, was rebranded in November 2025 as the Base app.
And this is a huge strategic pivot.
It is. The goal is to create a true crypto everything app by combining social media features, messaging, trading, and payments, all built on their proprietary Ethereum Layer 2 network, Base. It's an attempt to move beyond mere trading into becoming a core social and financial utility layer.
They've also fully integrated into traditional payment and stablecoin infrastructure.
For sure. They offer the Coinbase card, which is a debit Visa card that lets customers spend crypto directly anywhere Visa is accepted.
And their foundational role with USD Coin gives them immense influence over global stablecoin liquidity.
It does. Furthermore, they are actively building on-ramps and off-ramps, evidenced by adding Apple Pay support to their on-ramp platform in late 2024, letting third-party apps fund crypto purchases directly through familiar payment methods.
Shifting to the institutional side, the offerings are much more specialized, reflecting the needs of massive financial players.
The flagship offering here is Coinbase Prime, the tailored trading platform specifically dedicated to institutional clients. But perhaps the most critical service is Coinbase Custody.
This is where they hold Bitcoin and other cryptos for those large institutional clients in secure cold storage accounts. Why is cold storage so important, and how does it differ from a retail account?
Well, cold storage means the digital assets are held completely offline, not connected to the internet, which dramatically reduces the risk of cyber theft.
And for institutions managing billions of dollars, that security level is non-negotiable.
Absolutely. It requires Coinbase to meet stringent compliance and audit standards, reinforcing their image as a secure vault for digital assets.
They are also building robust infrastructure for commerce.
Yes. Coinbase Commerce allows merchants to accept crypto payments through simple web integrations like buttons and hosted checkout pages.
And Coinbase Payments takes that even further.
It does. It offers a stablecoin payment service for e-commerce, providing the necessary connective tissue for authorization, refunds, and subscriptions, making crypto acceptance feel as smooth as using a credit card.
And to round out their ecosystem, they're focused on developers.
Right. They provide the Coinbase Developer Platform and an API for building applications and accepting digital payments. This is about building the next generation of crypto-enabled businesses on top of their infrastructure.
And they're still eager for new markets.
They are. In November 2025, they announced a significant expansion into prediction markets through a high-profile partnership with Kalshi, further diversifying their revenue streams beyond core trading fees.
Now, all these products, custody, prime, advanced, base, are built around a central tension that every user has to understand.
And that's the reality of centralized custody versus the myth of crypto autonomy.
Which brings us to the most critical disclosure they made in a Form 10Q filing back in May 2022. This is a massive aha moment that many customers may not fully grasp.
It's so important to understand this.
Let's dedicate some time to explaining the unsecured creditor risk. What exactly did Coinbase state in that SEC filing?
Coinbase explicitly disclosed that if the company were to face bankruptcy, the crypto assets held in custody for customers could be subject to bankruptcy proceedings, and such customers could be treated as our general unsecured creditors.
Okay, let's unpack the legal implications of that statement for the average person. Why is that disclosure so alarming?
Well, in traditional banking, if a bank fails, your deposits are typically insured by the FDIC up to a certain limit or held in segregated accounts.
This disclosure states that your crypto, even if you own it, is commingled on their balance sheet to a degree that, upon bankruptcy, it wouldn't be treated as your property.
Exactly. It's not in a little safety deposit box with your name on it. Instead, you would be treated like any other creditor the company owes money to, like a supplier or a bondholder.
Which means you would get pennies on the dollar, maybe years later, if the bankruptcy court decides you're due anything at all.
Potentially. It fundamentally dismantles the idea that funds held on a centralized exchange are safe and segregated from the company's own operating risks.
It connects directly back to that early philosophical choice to offer a custodial wallet instead of requiring users to hold their own keys.
It's the ultimate trade-off. You surrender a critical layer of control and security for the convenience, liquidity, and perceived legality of using the exchange. That disclosure, made during the crypto winter, was a stark reminder of the inherent risk.
And what about the myth of anonymity? If Coinbase is so focused on compliance, users need to understand the fundamental reality of privacy on their platform.
The myth of anonymity is completely dissolved here. For registered users, Coinbase trades are categorically not anonymous.
Because they're a regulated financial institution.
Right. They are required to collect your taxpayer ID, verify your identity through Know Your Customer or KYC protocols, and report transactions to the IRS.
And to adhere strictly to anti-money laundering, or AML, regulations, Coinbase makes a deliberate choice not to trade cryptocurrencies with enhanced anonymity protection.
Yes, like Monero.
So they offer over 250 currencies to U.S. customers, but they explicitly exclude those anonymity coins. This is a strategic compliance choice.
It's the clearest possible signal of their compliance-first identity. They choose to exclude assets that make government tracking difficult, even if those assets align more closely with the crypto ideal of privacy. It's a sacrifice of a core decentralized ethos in favor of operating within the established U.S. financial and legal framework.
To truly grasp the pressure Coinbase operates under, we have to look at their financial trajectory, which is a perfect chart of the boom and bust cycles of the crypto market.
It is. The data from 2019 to 2024 tells an astonishing story of volatility.
In 2019, they were still a relatively small player in global finance.
That's right. Revenue of just over $500 million, resulting in a modest net loss of $30 million. They were still investing heavily with venture capital backing.
Then came the peak of the 2021 bull market, fueled by market excitement and their IPO.
Explosive. Revenue multiplied by nearly 15 times, hitting $7.8 billion, which translated into a phenomenal net income of $3.6 billion.
And the total assets held on the platform soared to $278 billion.
They completely justified their valuation and their strategy.
But the crypto winter of 2022 hit them devastatingly hard.
Oh, it did. Revenue plummeted to $3.1 billion, and they recorded their single worst year ever, a devastating net loss of $2.6 billion.
That loss was the direct cause of the massive layoffs we discussed earlier and forced them into a serious period of strategic contraction.
And that pivot toward institutional services.
Yet the recovery by 2024 shows their resilience and the success of that institutional pivot.
Revenue climbed robustly back up to $6.5 billion, with a strong net income of $2.5 billion. By the close of 2024, total assets managed by the company had swelled to $404 billion.
And the growth continued through 2025.
Yes. As of October 2025, they hold nearly $516 billion in digital assets. They are the largest U.S. exchange, the world's biggest Bitcoin custodian holding over 12% of all Bitcoin in existence, and a foundational validator for Ethereum.
That kind of scale puts their compliance and customer service under an intense magnifying glass. And historically, their customer service track record is surprisingly poor for a company of this stature.
It really is an indictment of their early scale. For a significant period, from 2018 up to 2023, Coinbase maintained an F rating from the Better Business Bureau.
And the complaints were chronic and severe.
They were. From users being suddenly locked out of their accounts to customers reporting it was nearly impossible to reach human support after a problem arose. The sheer volume of complaints was staggering.
That scale of failure in basic support must have eroded trust among retail users. Though, as noted, they have since reversed that trend and improved their rating to an A+ as of 2025.
They clearly had to. That kind of operational risk is unacceptable for a public company.
Beyond customer service, they faced concrete trading compliance issues early on.
They did. In February 2018, they admitted to overcharging customers for credit and debit crypto purchases because banks changed the merchant category code to process crypto as cash advances, which triggered unexpected fees.
And they also faced scrutiny from the CFTC regarding their reported trading volumes.
Yes. In March 2021, right before their public listing, Coinbase agreed to pay $6.5 million to settle claims from the Commodity Futures Trading Commission that they had reported misleading information about their trading volumes.
Which was a significant strike against their transparency and market conduct leading up to the IPO. Now let's talk about the massive regulatory penalties they paid, separate from the SEC legal fight. This reveals a clear pattern of compliance programs failing to scale.
The biggest one came from the New York State Department of Financial Services, the NYDFS, in January 2023.
And Coinbase agreed to pay a punishing $50 million penalty for breaking core anti-money laundering, or AML, laws.
And the penalty wasn't just the fine. They were required to invest an additional $50 million into their compliance program under NYDFS supervision.
What specifically was the breakdown that led to this massive fine?
The central allegation was a catastrophic failure in transaction monitoring. The NYDFS found that Coinbase was completely unable to keep up with the volume of alerts generated by its system.
Alerts designed to flag suspicious activity.
Right. This resulted in an accumulated backlog of over 100,000 unreviewed alerts, meaning they were failing to report and investigate suspicious transactions in a timely manner. They had grown too quickly, and their compliance systems just couldn't handle the load.
And this pattern was mirrored globally, which indicates a systemic failure across jurisdictions.
Absolutely. That same month, the Dutch central bank fined Coinbase 3.3 million euros for failing to obtain the correct registration in the Netherlands.
And in July 2024, the UK's Financial Conduct Authority fined their UK branch £3.5 million for breaching a voluntary agreement.
The breach involved unintentionally onboarding high-risk customers, though Coinbase reported this was only about 0.34% of their total, which the regulator stated increased the risk of money laundering.
If you look at this entire collection of fines, NYDFS, Dutch, UK, the CFTC, it powerfully demonstrates the immense high cost of trying to operate as a centralized, law-abiding exchange in this borderless, digitally liquid industry.
It does. They chose compliance, but they had to pay hundreds of millions of dollars, either in fines or forced investment, to upgrade their internal controls to meet the standards required of a global financial powerhouse.
Finally, we have to revisit the 2022 landmark case that signaled a new era of enforcement. The first ever crypto insider trading case, which involved a former Coinbase product manager.
This case was narrative gold for prosecutors. In July 2022, they charged former Coinbase product manager Ishan Wahi, his brother Nikhil Wahi, and a friend, Samir Ramani.
And Ishan Wahi, because of his position, allegedly shared confidential information about which tokens were about to be listed on the exchange.
Right, and this insider information allowed the defendants to trade those tokens before the listing announcements drove up the price, resulting in an alleged illicit profit of over $1.5 million.
The narrative got even more dramatic when Ishan Wahi, upon being summoned by Coinbase for a meeting, attempted to buy a one-way ticket to India and was intercepted by law enforcement at the airport.
Classic. And Coinbase cooperated fully with the investigation.
Of course.
They assisted prosecutors by providing information from their own internal investigation into the matter, again reinforcing their image as a proactive compliance-first actor.
And the outcomes were significant.
They were. Nikhil Wahi was sentenced to 10 months in prison. Ishan Wahi pleaded guilty later and received a 2-year prison sentence and was ordered to forfeit assets. The third defendant, Ramani, remains at large.
What's the precedent here?
This case sets a powerful precedent. It proved that traditional insider trading laws apply fully to centralized crypto exchanges and the assets listed on them. It was a clear warning that regulators and prosecutors were ready to use federal securities fraud statutes to police the crypto market.
So what does this all mean for the learner today? We've covered a massive amount of ground, watching Coinbase rapidly scale from a small Y Combinator project to a trillion-dollar valuation at its peak, and eventually an S&P 500 company.
And their story is undeniably the story of cryptocurrency attempting to mature under intense regulatory pressure, both in the US and globally.
The big picture is that their strategy of prioritizing compliance and institutional trust has delivered tremendous results.
It has. It's established them as the world's largest Bitcoin custodian and a foundational component of the Ethereum network. Yet that path has cost them dearly. From intense internal turbulence over values to massive regulatory fines and the ultimate existential SEC showdown that only ended because of a political shift.
Their identity is clear. They are a regulated financial entity first and a crypto advocate second.
And this required them to sacrifice some of those decentralized ideals of privacy and non-custodial ownership.
And that sacrifice brings us back to the fundamental question of user risk.
Right. Given that explicit disclosure in their SEC filing that customer assets could be treated as those of a general unsecured creditor in a bankruptcy, what is the true comprehensive cost of operating as a conservative, law-abiding exchange in this revolutionary decentralized industry?
And more specifically for you, the learner, what level of risk does that necessary compromise, the convenience of custody in exchange for being an unsecured creditor, leave for you as the individual customer who entrusts your assets to an S&P 500 powerhouse, no matter how much they invest in compliance?
The journey from a garage startup to a financial powerhouse dealing with billion-dollar acquisitions and $400 million cybersecurity threats proves that in the world of centralized, regulated crypto, there truly is no such thing as a quiet day at the office. Something profound to mull over until our next deep dive.